NVIDIA just reported growth numbers that would make any retail investor celebrate. But here is what they are not telling you. While you were reading headlines about exceptional revenue in April 2026, institutional desks were quietly having a very different conversation. The conversation was not about growth, it was about valuation, and specifically, whether NVIDIA has entered the exact same trap that destroyed Cisco shareholders in 2000. Because right now, there is a macro conflict brewing that most retail investors are completely blind to. NVIDIA CEO Jensen Huang just went on record saying US AI export restrictions are backfiring. That is not a throwaway comment. That is a signal that the geopolitical chessboard is shifting underneath the AI hardware trade. And institutions are repositioning accordingly. Let me show you the data cross-verification that reveals what is really happening. First, Chinese semiconductor fabs just imported record volumes of US chip-making equipment through Singapore and Malaysia. This is not speculation. This is documented flow happening right now in April 2026. What does that tell you? It tells you that export controls are not restricting supply. They are simply rerouting it and creating margin compression for US tool makers. Second data point, homegrown Chinese chip-making tool manufacturers booked record revenues in 2025 as price competition squeezed margins. Connect those two dots. The US government thought export limits would choke China's AI ambitions. Instead, they accelerated domestic substitution and created a parallel supply chain that is now undercutting US pricing power. This is the macro setup that institutions are trading right now, and it has direct implications for NVIDIA's valuation multiple. Because if AI hardware becomes commoditized faster than the market expects, NVIDIA's premium valuation has nowhere to hide. Now let me give you the 3 tickers that are directly derived from this exact news context. Ticker 1, SMH, the VanEck Semiconductor ETF. This is where you see the broadest institutional rotation when smart money starts de-risking single-name concentration in NVIDIA. Ticker 2, SOXX, the iShares Semiconductor ETF. Notice the subtle difference. SOXX has higher exposure to semiconductor equipment makers, which are the actual beneficiaries of the rerouted Chinese demand I just described. Ticker 3, TSMC, Taiwan Semiconductor Manufacturing. They just locked in a deal to manufacture Tesla's new FSD hardware. That is diversification away from pure AI data center dependency. And institutions love diversification when valuation risk is rising. Now here is the historical case study that should terrify you. March 2000, Cisco Systems. Cisco was the NVIDIA of the .com era. Exceptional growth, dominant market position. Everyone said it was different this time because the internet was the future. They were right about the internet. They were catastrophically wrong about the valuation. Cisco peaked at a price-to-sales ratio of 35. NVIDIA is currently trading at a price-to-sales ratio above 30 in April 2026. Do you see the pattern? Cisco's revenue kept growing for years after the peak, but the stock lost 89% of its value because the multiple collapsed. Growth does not save you when valuation resets. And right now, the macro catalyst for a valuation reset is staring us in the face. Backfiring export controls, margin compression from Chinese competition, geopolitical arbitrage creating supply chain redundancy. These are not bullish catalysts for a 30 times sales multiple. So what is the institutional playbook? They are not selling NVIDIA outright. They are rotating into broader semiconductor exposure through SMH and SOX. They are hedging single-name risk by adding TSMC. And they are waiting for retail to figure out what they already know. Exceptional growth is not the same as exceptional value. The smart money versus dumb money divide has never been clearer. One side is reading headlines. The other side is reading export flow data and valuation comps to Cisco 2000. Which side are you on? This is not financial advice. This is educational content only. All investment decisions carry risk. Do your own research and consult a licensed financial advisor before making any portfolio changes.